Welcome to our economic and proposed tax law change update. Let's quickly review some highlights of 2017. The first quarter of 2017 ranks as the third best start for equities. The bull market officially turned 8 years old on March 9th. In March, the Dow Jones Industrial Average passed a new milestone of 21,000 for the first time. The Federal Reserve raised the federal funds rate by 25 basis points to 75 basis points to a full point in March. Investors and savers had concerns cash equivalents are at low yields and their returns could potentially be eaten up by inflation. Overall, investors saw a very healthy start to 2017. There is still debate on whether the bull market is still in its prime or on its way out. Although the market seems to be fully valued, there remains significant data that suggests the market can go higher. One key example, FactSet Research projects corporate earnings to rise 8.7% in the second quarter this year, another 8.2% in the third quarter, and 12.6% in the fourth quarter of this year, with revenues rising over 5% in each quarter. The key point to keep in mind here is to try to remain non-emotional and not make any rash decisions based on any one isolated set of facts. As always, we are closely monitoring all clients' personal portfolios and goals. The S&P 500 quarterly year-over-year growth as of May 2017 showed a 15% rise. This was the best year-over-year since the third quarter of 2011. On the other hand, the S&P 500 price-to-earnings ratio shows we are still above the average. This typically shows that the average stock valuation is higher than usual, but in summary, while earnings are strong, valuations remain high, yet valuations could go even higher before they level off. As mentioned earlier, the Federal Reserve raised the federal funds rate by 25 basis points in March. This rate hike was the first of the three that the Federal Reserve suggests we could see this year. According to David Payne, staff economist for Kiplinger, the Federal Open Market Committee meeting was significant in that the Fed now appears committed to a path of steady rate hikes. It will probably lift short-term rates by 0.25% at least two more times in 2017. Please keep in mind that when the Fed raises rates, it pushes up yields on short-term bonds, but yields on 10-year bonds can be affected by a host of other factors, including risk sentiment, expectations for inflation and economic growth, and investor demand for longer maturity securities. In short, long-term bonds may not be as impacted by rate increases, including mortgage loans. As you may already know, when interest rates rise, bond prices go down. We try to keep a watchful eye on both interest rates and bond prices. While politics seems to steal the nightly headlines, our outlook is positive for the global economy. Consumer debt is manageable. Central banks are still stimulative, even though the U.S. Fed is slowing its stimulus. Consumer confidence is strong, manufacturing is growing in the U.S., and commodity prices have been down, thus allowing lower-income countries some financial relief. There are some long-term concerns, however. Financial obligations of some countries are high. The U.S. has yet to get serious about fiscal policy, and protectionism and populism create uncertainty, and central banks have limited options available at this time to stimulate the economy if a situation occurs. According to BlackRock, the world's largest asset manager, they feel these key points should be carefully followed. Global growth is expected to rise in the near future. Inflation expectations have rebounded from their lows in mid-2016, and actual inflation is slowly following. Although inflation may remain subdued over the long term, this outlook appears to be currently priced into asset markets, but we need to keep monitoring inflation trends. The search for yield is still on. Although short-end rates are rising slowly, long-term rates still remain at historically very low levels. Now let's review some of the currently proposed tax law changes. The initial proposal was a one-page term sheet that stated discussions would then begin to frame a detailed plan. Of all the propositions, there seem to be four non-negotiable principles, which are 1. Create a more competitive corporate taxation landscape. 2. Allow for a repatriation of overseas earnings. 3. Make changes that simplify the tax code. And 4. Provide a middle-class tax cut. Steven Mnuchin stated during the press conference that the goal of cutting individual and corporate taxes is to generate annual GDP growth in the U.S. of 3%. Now let's briefly review some of the initial memo's key strategies. The Trump administration wants to reduce the corporate tax rate to 15%. This means lowering from 35% to bring the rate closer to most other industrialized nations. A special one-time repatriation tax to encourage companies to bring back and pay taxes on money they made overseas. They would like to allow a pass-through rate for business owners, so business owners would have income from operations taxed at only 15%. Currently, the tax code has 7 tax rates. The House of Representatives initially wanted 3 brackets, and Trump's campaign proposal was the same. 3 tax brackets of 12%, 25%, and 33%. However, this current proposal brings 3 tax brackets, but they are 10%, 25%, and 35%. Already, this could be a sign that change is possible, and although the 3 proposed tax brackets have changed, moving from 7 to 3 tax brackets would provide some simplification. Another simplification called for is to increase standard deductions while eliminating overall deductions. Specifically, the proposal is to double the standard individual tax deduction. Again, this new proposal differs from the campaign proposal, but seems to be more toward a simpler tax code. The proposal also called for the elimination of all itemized tax deductions other than charitable donations and mortgage payments. This currently includes no more deduction of state and local income tax, which has some taxpayers concerned who live in high tax rates. Please keep in mind, this is a proposal, not a law, and this is the beginning, not the end of a tax debate. The proposal would also like to repeal the alternative minimum tax. This requires those with large amounts of deductions to calculate their income under the normal tax rate and the alternative and pay the higher amount. Currently, in 2017, the AMT could apply to any single filers earning more than $54,300 and any couple filing jointly over $84,500 in income. Currently, we have an estate tax and step-up of basis at time of death. The House of Representatives proposed to have no estate tax and a step-up. During the Trump campaign, it was proposed to have no estate tax and no step-up for assets which exceeded $10 million. The removal of the estate tax would allow someone to pass down their wealth to anyone they choose without the possibility of federal taxation on their assets. Permanent is not always permanent. According to current law, the Byrd Rule, named after Senator Byrd who created it, allows senators during the reconciliation process to block legislation if it possibly would increase significantly the federal deficit beyond a 10-year term, or is otherwise an extraneous matter as set forth in the Budget Act. An example of the Byrd Rule was the Economic Growth and Tax Relief Reconciliation Act of 2001, which started in 2001, and because of this rule, it sunset at the end of 2010. Thank you for listening to our economic update and proposed tax law changes. If you have any questions, please feel free to call.